Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by Abbey Capital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, Abbey Capital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With Abbey Capital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, host Bill welcomes Kevin Donohoe from Abbey Capital to discuss the intricate world of hedge funds and managed futures. Kevin provides an extensive overview of his background, initially aspiring to be a lawyer and eventually finding his passion in finance and trading. As the head of research at Abbey Capital, Kevin shares insights into the company's evolution, its managed futures strategy, and the importance of multi-manager approaches in asset management. The discussion also covers various aspects of commodity trading advisors, CTAs, different trading strategies within managed futures, and the significance of uncorrelated returns in investment portfolios. Listen in.
Kevin Donohoe, welcome to Educational Alpha.
Thanks, Bill. Really delighted to join you today.
No, my pleasure. So I've known Abbey a reasonably long time, and the U.S. proud of your tribe, are very, very good friends of ours. We did an event in New York just last week, I think our largest chapter event in the history of Kaya, and Helen, Barry, and Dan were there representing Abbey, showing the flag and kindly supporting us as a sponsor, which is a not-for-profit educational provider we absolutely need. And you are certainly representing an organization that puts education transparency as part of your brand. First and foremost, thank you and congratulations for that. I think we've got a lot of interesting things to cover, most notably perhaps bringing more transparency to maybe part of the $5 trillion of hedge funds, if I can use that broader term, described by the CTA space, which is where you toil. I think we've got a lot of interesting things to explore there. But before we get there, Kevin, maybe a little bit of your background. I think most of your career has been in Dublin and maybe a good chunk of it at Abbey, but maybe a bit of your background first.
Yeah, that's true. A lot of time with Abbey, as you say. My name is Kevin Donohoe and I'm the head of research at Abbey Capital. I started out my career actually thinking that I wanted to be a lawyer. I undertook a dual degree in law and business in University College Dublin, beginning in 2000. And through the course of that 4-year degree, really discovered that the sort of business and more specifically the finance side of that course was really what interested me most. And I think I'd always had a very strong connection with sort of maths, physics, engineering type subjects that I'd done previously in my education. And so that was a strong draw at that time. As that sort of developed, I really centered on a desire to be involved in markets and trading more specifically around that time. I did a master's in finance and capital markets with a view leaning more into that sphere. And after that, went trading for a number of years with a couple of different proprietary trading houses around Dublin. So they were very formative times for me in terms of my career development. That time overlapped with the collapse of Lehman and the global financial crisis. So in terms of learning and understanding what it felt like to have risk at play in the market as a proprietary trader, it was a very interesting, but as I say, quite a formative time for myself in terms of how I thought about risk and thought about investment management. After that, the financial crisis had left a fairly indelible mark on the banking sector in Dublin, and I went to work with one of the banks as part of a team that was de-risking the derivative book that had been left behind after what was effectively a failed commercial loan book at that point after the bank had been nationalised. So I did that for a couple of years as a sort of a project role, but really I wanted to get more specifically back into investment management and asset management. And at that stage, around 2013, the opportunity to join Abbey came up. I was really drawn by the investment philosophy at Abbey and a thoughtful and process-driven approach to investment management. And so I joined the desk as a research analyst back in 2013, a little bit over 10 years ago now. And I've worked through the Abbey process, as it were, learning very much the world of managed futures through that lens, through sort of a multi-manager lens, as we'll get into maybe later on. In recent years, over the last sort of 5 or 6 years, I've joined the investment committee at Abbey and would be a part of the day-to-day running of the research and investment team alongside our director of research, John Toomey. Hopefully that gives you a sense of my sort of trajectory to this point.
A helpful background, and I'll commend you for not necessarily pursuing law. I don't know if it pays as well, although there are some law firms in the private market side where the partners are doing quite well. But I think certainly from where I sit, you made some very good decisions. Just maybe a couple of factoids at Abbey in terms of age and sizing, so we know a little bit about who Abbey is.
The business began back in April 2000. We launched the first of our products back in December 2000, then the ACL Alternative Fund private placement offering. And that really is very consistent with what our investment philosophy would be right to this day. From a philosophy standpoint, Abbey began with the idea of equities for the long term and the need for a really effective diversifiers to sit alongside that equity portfolio. And that's where the principles of our business felt that managed futures, and again, a multi-manager approach to managed futures, would really fit. So the business has evolved really since that launch back in 24 years ago or so. From an initial point of offering private placement products in 2014, we launched the first of 2 US mutual fund products, 2 40 Act products that we run. Again, that first product was multi-manager managed futures in focus, similar to our private placement vehicle. And more recently then in 2018, we launched the second of those 2 US mutual funds, which is more of a multi-asset strategy. So it combines a portfolio of trend following CTAs with a long US equity holding. So again, very consistent with the original premise or investment philosophy of the business. The third peg to our business is customized mandates. So we offer and run a number of custom portfolios for larger institutional clients, maybe fund of one type vehicles. So those 3 business lines sit alongside each other, and the commonality between them all, as I said, is a multi-manager approach to manage futures investing. In totality, we're managing about $6.5 billion in client AUM. We allocate just north of $8 billion across 8 unique portfolios. That's effectively where the business sits today.
I think that's helpful context to have in advance of maybe doing a slightly deeper dive on the wonderful world of CTAs. So maybe starting at the top, if I were to go to Preqin or PitchBook and they talk about the size of alternatives, and I think they've recently pegged it somewhere in the high teens on its way to maybe the mid to high 20s in the next 5 years. And hard number to get your arms wrapped around, particularly in the private markets in terms of funded capital, et cetera, but I'm not going to try to solve for that. But when it comes to CTAs, it's got to go into one of these broader buckets. And the place I normally see it is in the hedge fund bucket, which I think is sized to round up or down about $5 trillion. Is that the right way to think about it, broadly speaking? Is it in the hedge fund bucket? And yes or no, where it should be, but then just maybe give me a relative size of the CTA market in terms of that total 5 trillion or this 18 trillion of alts.
Yeah, I think traditionally that's where it's categorized within the hedge fund space. People think of it as well as very much in recent times more as a liquid alternative. I guess that sort of speaks to some of its characteristics, such as daily liquidity. But in terms of sizing, your estimate is probably around where we would see it. Approximately sort of 10% or so of the global hedge fund industry, I think, is a reasonable estimation for the sizing of the space.
Drilling down from that then, again, my words, not yours, Kevin, I think there's a tendency to talk about hedge funds as an asset class, which I think is foolish. There's certain global publications out of the UK that are not big fans of hedge funds. I think to indict what is a very complex industry doesn't make a lot of sense. And then even inside of the 400 billion or so in the CTA space, there are a lot of different styles in there too. So to diminish hedge funds means diminishing a lot of different uncorrelated strategies. And then even inside of CTAs, as I said, there's a lot of optionality there in terms of where the investor wants to go. So I'm not going to solve for why people don't like hedge funds necessarily, but could you maybe list the key strategies that would maybe roll up into that 400 billion of CTA assets?
I think CTAs, managed futures strategies, trend following strategies, these are all terms that we hear that are synonymous with managed futures industry as such. They all describe specific styles or refer to styles within it, I guess. At the simplest level, we typically break the universe of managers in the managed futures universe down to defining them first as either trend following or non-trend. That's really how we think about it in terms of portfolio management approach. Trend following is certainly, as we would see it, the core return driver of the CTA or managed futures space. It certainly explains the vast majority of the returns of the space and would be the dominant trading style within that. So that's sometimes why trend following and CTA or managed futures are terms that are very much substituted for one another. Outside of trend following, then, the non-trend space is certainly a little bit more diverse in terms of the types of strategies that fall within that. We think about this in terms of our portfolio management as a sort of a core and satellite approach. So trend following is often central in terms of the main driver of portfolio returns. But because trend following itself can experience periods of underperformance depending on market conditions, we see it as important to combine it with diversifying strategies drawn from elsewhere in the managed futures space. So when we think about categorizing these, some of the broader categories would be short-term systematic traders, for example, those that are operating at maybe a 10-day or less hold period, really taking advantage of both shorter-term momentum, but also more reversionary type of trading activity, and can be quite decorrelated from trend managers at the longer hold periods as a result of that. We also think about this in terms of global macro managers, both from a systematic and discretionary perspective, where these can differ from trend following and complement the trading style or the style of trend following trading is in the fact that some of their systems can be more fundamentally derived in terms of the inputs into their signal generation from a systematic macro perspective, and discretionary macro managers obviously approaching the market from a very different perspective than a systematic trend follower would be, for example. Those two categorizations certainly sit alongside one another. We also see relative value managers, so very much non-directional type traders operating in this space and looking at relative value opportunities in between sectors, in between the term structure of futures contracts, and again, can exhibit quite a differentiated profile to trend following as a result of that. So I would say those are the broad categorizations that we would see. And within them, you'll get differentiation then across various different lines as to whether managers will favor more sort of commodity heavy versus financials heavy approach in terms of their implementation, for example. But there are many ways that managers will deviate from one another.
Maybe that's a bit of the proof statement as to what Abbey brings to the marketplace, because you can do the due diligence and find exposure to at least these trend, non-trend, global macro, relative value, et cetera. If I wanted to, and maybe I can, and you can tell me I don't know enough about the space, if I wanted to go and buy an investable index to get exposure to this beta very, very cheaply, A, can I do that? And if I do, am I going to have disproportionate exposure to one of these underlying types of strategies?
There are a number of benchmark indices that are used more from a sort of a reporting perspective and in terms of observing the performance profile of certain cohorts of the managers within the space. In terms of investability, that doesn't tend to be something that's available. Now, we do see sort of replication strategies, maybe looking at some of those reported indices, but the trading characteristics of those for us sometimes fall within similar lines to the profile of individual managers. It's not so clear in terms of accessing that multiple index related approach.
If I look at trend following, non-trend, global macro, relative value, what kind of correlation over time would I have either between any two or amongst that group?
Yeah, it's a really interesting question, and it's something that we spend a huge amount of our time on here. When I mentioned earlier on us thinking of this in terms of trend and non-trend and maybe core and satellite in terms of our portfolio construction or portfolio management, for us, we're looking for diversification across our trend followers from one another in the first instance. If I bring this back a little bit to where we would see our place in this space, maybe there's a couple of very key characteristics of the managed futures universe that we feel makes a multi-manager approach somewhat compelling. The first of those is that there's very high dispersion of returns across managers in the universe. Even managers who exhibit quite a high correlation to one another can have very different return outcomes in discrete periods. And there's a number of reasons for that. Two trend followers might be long-term trend followers in classification, but they might have nuanced approaches to how they do that. A manager who uses more moving average crossover compared to price breakout or volatility breakout or momentum type strategies might enter and exit their trades at slightly different times. And that'll give rise to differentiation in terms of how they experience the market. That's one simple example. You could extend that to comparing a trend follower who operates on a 30-day hold period compared to a trend follower who operates more at a 150-day average hold period. Those two managers are experiencing very different markets in terms of how they assess trends and directional moves in markets. They can exhibit quite diversifying properties to one another. We typically see the sort of cross correlation across the dominant trend following managers in the space in the region of 0.7 or 0.8 over time. But even that said, we would see quite disperse outcomes in terms of their return outcomes. The other way to think about this then is not only do we see very high dispersion of returns, we see very little persistence of it. As the environment changes from year to year or from month to month or quarter to quarter, it'll change to suit different managers' strategies differently. The decisions that managers make in terms of how they put their strategy together, whether it's, as I said, more focused on certain flavors of trend following, more biased to financials versus commodity markets, or other decisions they'll make around the allocation of risk, those are all things that will drive differentiated outcomes, and they result in very little persistence. So you get very little evidence of individual managers outperforming for persistent periods of time. And so when we look at this and thinking about your question around correlation, we're really looking to get an understanding of all those elements that make managers different and how we can then rely on those to think about how we build portfolios. What are the drivers of dispersion ultimately, and how can we get an understanding of that can make the composition of a portfolio or the use of varying differentiated managers valuable in a portfolio context? Bringing it back to that idea of trend versus non-trend, we typically look for non-trend strategies to be 0.3 or less correlated to trend managers. There's a lot of considerations that will go into why a non-trend manager might add value to our portfolios, but that would be a key starting point for us in terms of their ability to deliver diversification to that trend risk that might be at the core of the portfolio.
I probably have already answered this, but maybe a follow-up. So I would assume a big part of what Abbey looks to offer as part of your overall product is manager selection. And if you're looking for the very best, maybe that's not the right way to put it, but if you look at global macro, for instance, I would assume from the median to the top quartile, there's a lot of performance dispersion even amongst global macro managers. So part of it is to get the cross-correlation benefit you talked about amongst these various strategies. But is it a fair statement to say even within global macro relative value, as you're sourcing managers to come onto your platform, I assume the performance dispersion over periods of time can be very wide?
You could argue actually that the performance dispersion for the non-trend classifications is possibly even larger than comparing trend managers to one another, because there's a lot more commonality in terms of the approach maybe that trend managers have to one another. When we look at some of the classifications that I mentioned earlier on, such as short-term systematic, relative value, and macro from both a systematic and discretionary perspective, you're completely right that the differentiated types of approach that managers take there will result often in quite uncorrelated return streams compared to one another and quite dispersive outcomes. So this is something, again, that we think very deeply about in our own management of portfolios, is that we want to try and understand as much of the breadth of risk types that exist in the managed futures universe. And we build over time a qualitative understanding of what individual managers will do, and then try and evidence that quantitatively in the data that we see from those strategies. Over time, that helps us to build a conviction or an expectation around what a manager might provide in the context of a portfolio and alongside the other managers that we might sit beside them in that portfolio context. Getting an understanding of that differentiation and, again, to use that phrase I used earlier on, the drivers of that dispersion. If we can get an understanding of that, it helps us then to build portfolios potentially that are using managers that have a profile that are complementary in nature to one another.
Maybe one more follow-up on this line of thinking, Kevin. I think an unfair question would be what percent in a model portfolio should go to CTAs? I think maybe one response would be, you haven't given me enough information. What's the profile of that investor? What is their job? Do they have exposure to commodities or global macro issues? And there's so much that goes into that. So maybe I'll try to come at it another way. And why should an investor be thinking about CTAs full stop in their portfolio? I'm going to start with both global macro and relative value. So if I think about where the world is today and where it's going, we're long geopolitical risk, long global macro risk. In this period of turmoil, assets are being mispriced left and right. So I think the opportunities around relative value are out there as well. And volatility, I think, is hiding in plain sight. I'm amazed how placid it is. And I think we're, one election or one crisis away from, I don't know what. Volatility should be higher, at least in my opinion. All that would lead me to believe thinking about exposure to this space would make some sense. So again, I'm not asking you to say 2.5 or 12.5% should be the target allocation, more about why should an investor, either like me as an individual who might have access to a 40 Act fund or a very sophisticated institution, be thinking about access to this asset class, particularly at this stage of the market?
It's a fascinating question, Bill, and it's something that comes up in a lot of our engagements with investors, with prospective investors. And it's something that we can't answer directly, as you say. The sizing element comes down to very subjective considerations on the investor side. What I would say is that when we think about building portfolios of multi-manager managed futures solutions, we don't think about that in isolation. What's really important for us to understand that as specialists in the managed futures space, we operate in a much, much larger ecosystem. And the people who look to potentially access these types of strategies are doing so to sit them as potential sources of diversification in much broader portfolio contexts. And so we think about that at the very start and throughout our investment process. We're not trying to maximize the Sharpe ratio of a multi-manager managed futures portfolio in isolation. We're doing that with an objective to deliver a diversified return profile compared to traditional asset classes, because that's often where these strategies are sitting alongside broader equity or fixed income portfolios. When we look at the return profile of managed futures, and something we were thinking about earlier on is the value add of managed futures to investors, over the long term, these types of strategies, trend following CTA managed future strategies, have delivered very uncorrelated return profiles compared to equity markets, where you have zero or slightly negative correlation to equity markets and a very low positive correlation to fixed income markets in the region of 0.1, 0.2 correlation. So as a portfolio diversifier, managed futures strategies can have a very meaningful impact in terms of drawdown reduction potentially and improving the Sharpe ratio of the overall portfolio. And that's really how we think about it. A key factor for us in considering managers, and you mentioned the manager selection component maybe that we potentially offer as part of what we do, a key component or a key factor that we would consider in that is an individual manager's profile in the context of equity and fixed income markets, their correlation not just to other CTAs, but their conditional correlation to traditional asset classes is very important, because if we want to produce a portfolio at the endpoint that has those types of attributes and is very lowly correlated to equities, lowly correlated to bonds, then we need to think about that right from the building blocks level. That's very important. That then feeds into sizing. And the question of sizing for investors, as I said, is very subjective. But it comes back to, I think, understanding the profile of the returns. If managed futures strategies are zero correlated, say, for example, to equity markets, you'll have to understand that there will be periods where managed futures will be up at the same time that equities are up, and down at times when equities are up, and about half the time each for those, in order to end up at that zero correlation. So compared to some other alternative strategies, which can have a higher equity beta, for example, CTAs can sometimes have a disproportionate amount of focus on them if they happen to be the line item that's trailing in a portfolio when equities, for example, are performing very strongly. That's where a lot of the challenge and the sizing question comes back to, is that investors have to be conscious of the types of drawdown, for example, that managed future strategies can have, the reasons for those types of drawdowns, and also understand that the idea of holding these strategies over the longer term, potentially, and a consistent allocation to them is more important than trying to time these things.
Very good points. And of everything you just said, Kevin, I wrote down only one word, which was uncorrelated. It's important, I think, to put a bold underscore on that, because that doesn't mean better absolute returns. It means better risk-adjusted returns. And again, my observation that you don't have to agree with, but I think since the GFC up until maybe 2022, it's been a risk-on market. And I think this is true of hedge funds, maybe a little bit in CTA as well, that I think investors were trained to want 100% of the upside and 0% of the down. And everything became compared to the All Country World Index. And if that was up 22 last year, why are you up 5? It's uncorrelated. I think that sometimes that is such an important message about investing, once described by many smart people as a free lunch. And maybe it's still free, but if it was, I think you'd be giving your services away. Manager selection, it costs something. And you got to have a trusted partner that's willing to be able to do the due diligence. You can respond to that as more of a statement, but I think uncorrelated is really how we've got to be thinking about access to any asset class. And certainly I think the CTAs have proven that is part of the value proposition and a big part of it.
I really agree with that. And I think it comes back to maybe thinking more fundamentally about why is diversification so important in the first instance. The idea of having diversification or potentially building diversification into a portfolio and giving up maybe some of that, the 100% upside, as you say, is that in our view, certainly minimizing drawdown is an important factor or important consideration in managing portfolios. The effects of compounding mean that as you go into deeper and deeper drawdowns, it takes more positive return in order for you to get out of those drawdowns. A 20% drawdown, you have to make 25% back. A 50% drawdown, you have to make 100% back to get back to zero. And those numbers become very real as your drawdown deepens. By combining your traditional allocation or traditional asset allocation framework with alternative asset classes that can potentially deliver that type of diversification, you can limit the size and scale of the drawdown. And the reason why these things are important is that if you're an advisor and you're managing a book of business for your clients, you don't necessarily know when your clients are going to need liquidity. You don't necessarily know when a client is going to need to liquidate for personal reasons, for their own sort of family reasons, whatever it might be. And by building in those concepts of diversification and by having elements in your portfolio that help to potentially limit drawdowns over time, you potentially reduce the risk of being in a larger equity-led drawdown at that point when liquidity is required in response to those investor needs. I think incorporating these types of concepts around diversification to those traditional asset classes can be an important factor in managing broader portfolios.
I appreciate all that. Maybe just as we move toward wrap up, one last area for exploration is the phoenix of fintech that has arisen, maybe not from the ashes, but maybe there are some ashes there too. I'm going to start with maybe a non-topic, but a question, and you feel free to use an American football analogy. You can punt this one down the field if it's not in your wheelhouse. But big news here in the U.S. just a week ago, under maybe the threat of the D.C. Circuit Court, the SEC approved the first spot Bitcoin ETF. And I think as of last Friday, there were 11 of them. I haven't checked this week. But the futures market for currencies has been alive and well. And I know personally at least one trend following manager that has been using virtual cryptocurrencies because there's been a developed futures market for that. Is that something in the course of your travels? And if you say, hey, I'd rather not get into that, I'll let that go.
We see it for sure. We see a number of managers who have expanded their tradable universe into that space. It's not something that our portfolios are active in at this point, although some of the managers who we would have relationships with in terms of allocations within our portfolios would trade them in their own fund vehicle. It is something that we're familiar with. At the moment, it's something that we continue to monitor from an investment management perspective and haven't gone the route of incorporating it in. An important feature of how we allocate to managers is that we do solely through separately managed accounts. So we, as an investment team, get to control effectively the instruments that are traded on behalf of the funds that we manage. And so there are from time to time considerations that we would have that would lead us to exclude certain contracts. We're very keen to be able to access and deliver on the liquidity benefits of managed futures. Managed futures is by its nature daily liquid, and that's something that adds a huge degree of value potentially to investors because it allows them to respond to the needs of their portfolio elsewhere by accessing the liquidity of managed futures. And certainly in the past, there have been very important times when CTAs have been a crucial provider of liquidity to clients during stress events in markets. So we often think about that extension of the universe that managers are trading through the lens of liquidity and through the lens of these instruments being centrally cleared. As you mentioned, that is something that is now evolving. It's maturing a little bit more in terms of the cryptocurrency future market space, but to date, not something that we've incorporated into our own portfolios.
A helpful perspective. So maybe last question will have multiple parts to it so you can take this and run with it. So if I think about where fintech is, where it's going, and I think maybe the latest iteration is in generative AI, there's a ton of alt data out there. I assume that perhaps you're using it. Some of your underlying managers are using it in terms of these data sets. And then I think from your vantage point, maybe two ways. One, how you do due diligence on the managers you're hiring, and then how do clients do diligence on you. And I think ultimately there might be more black box-ish, but the prospect of the client would perhaps like it to be more glass-like so they could look and see through it, but it doesn't always work that way. So I said, maybe it's your observations around the fintech invasion and what that means in due diligence, and then maybe how much you're using some of these tools like generative AI.
The black box versus glass box visual is a very helpful one here. I think we need to be able to build up an intuition and a qualitative understanding of a strategy in order to have conviction in it, to incorporate it into our portfolios. We need to understand the drivers of return within that in order for us to be able to manage it appropriately, size it appropriately, allocate to it appropriately, and sit it appropriately alongside the other incumbent managers that we might have in a portfolio. You're right, though, these concepts are very prevalent in the space at the moment, but they're really nothing new, I would say, in terms of the managed futures CTA space. There are different naming conventions through time for these types of AI, machine learning, Bayesian techniques that have been prevalent throughout the space for many years. It's an industry that is comprised of many people who are mathematicians and very advanced levels of understanding of these concepts as they evolve. And so it's something that we've seen in terms of incorporation into strategies that we allocate to and that we monitor across the space for a very long time. The AI version of that is something that is quite new. Obviously, we're looking at it ourselves in terms of how we incorporate it into some of our internal sort of operational processes in the first instance, but we're also faced with it, as you say, from a due diligence perspective with our underlying managers. And I think that the way we've seen it incorporated has been very different across the space. We've seen machine learning, for example, techniques used in how managers handle data for a long time, how they handle their sort of execution algorithms. In some instances, it's more applied to signal generation, and in other instances, it might be more applied to how the balance of risk in a portfolio is managed and maneuvered over time. The implementation on a manager by manager basis can be quite different. So we need to be aware of that, and we factor it in both into our investment due diligence, but also into the independent and standalone operational due diligence that we would undertake on all of our managers on an ongoing basis. So we have a standalone operational due diligence team where there would be within Abbey a lot of expertise from the technology side of our business, for example. Abbey is a business that we build a lot of our own systems internally because of the sort of unique requirements that we have as a multi-manager managed future specialist who operates with managed accounts only. And so we have a lot of experience building that technology infrastructure in-house. And so we have a very significant technology footprint as part of our team of people here. And some of the more senior elements of that team would be central to the operational due diligence, as I say, that we would be doing to really understand the processes and systems and implementation that managers are seeking to do around these concepts.
Terrific. Well, we'll leave it at that, Kevin. So when I set out doing this podcast a year ago, and this is season 2, the simple value proposition is that education is alpha. These last 40 minutes, I'm smarter than I was when we started. You delivered in a non-commercial way. And as you wander past Stevens Green down Grafton Street for a Guinness to begin the weekend, maybe hoist it to our common friend, Helen Doody, who put this together. And I very much appreciate that she did and appreciate the educational outlook that you brought to the audience today. So thank you.
No problem, Bill. I hope it was helpful for the audience. And can I just say thank you very much again for your support and for having us on today.
Absolutely. All the best, Kevin. Thank you.
Thanks very much.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Kaya Association and subscribe to the show at kaya.org. That's CAIA.org. See you next time.